So hi everyone and welcome to AJ Bell's Autumn Off the Road webinar here in the South. We've been out and about over the last couple of weeks running these sessions across the UK, but we appreciate that actually many of you have been able to join us. So we're putting these catch-up sessions to ensure you get a chance to hear the fantastic content we delivered. So a recording of today's session will be available at the end of the week on the Info Centre portal. So if you'd like a recap or feel it'll be useful for a colleague, then please access it there and you can rewatch the content. So today's session does qualify for CPD and we'll supply a certificate based on your time in the session. So there's no diving out early, but we'll send this out via email in the coming days along with a copy of today's slides. But we very much have an action-packed agenda for you today. So without further ado, let's kick off. I'd be remiss without introducing myself. So I'm Greg Morton. I'm the regional manager for AJ Bell here in the Southwest. I would have spoken to a number of you before, but for those of you who haven't, I joined the business back in February of this year, having spent over 10 years in platform investment sales. So I started off with M&G, so formerly the Centric platform, and then moved on to Aegon, looking after institutional clients here in the Southwest. And then more recently, I was with FE Investments on their MPS proposition. I'll be honest, a question I've asked a lot since joining was why AJ Bell? So it's got a fantastic reputation in the market. It's got a really kind of wonderful proposition. And what I really liked is actually it's a really varied offering. I think after 10 years in platform sales, got a bit bored of having the kind of same kind of platform conversations. So from my side, it was really nice to have you've got the platform, you've got the investments, and you've also got some other wonderful things we're bringing to market as well. So it's a really varied offering. And since joining, it's all lived up to the expectations. I've been very, very impressed. I think the one thing I probably has been most impressed by has been the company culture. I think we've got lots of really great people that are very passionate, and almost oddly so, about delivering really good kind of service, improving the proposition, working with advisors, and it's always really, really refreshing. So yeah, it's been a good experience since coming in. And I think actually one of the things that best shows that company culture and a lot of things I've really liked is actually the support we offer to our advisors here in the Southwest. So again, having worked in the industry for a long time, for me, this is the best support structure I've come across. So here in the Southwest, you've got Alison Mollard, who's my boss. You've then got me from a face-to-face point of view, and you've got my colleague Ryan Meredith, who's my telephone equivalent based up in Manchester. We both work in tandem on the region, and we're both there to kind of cover the propositional development questions, the new business questions, that kind of area. And you've then got Sean Wilson down the bottom of your screen. So Sean is our business development support, and Sean's on hand for the kind of the how do I questions. So he'll work with you in the admin team in terms of training, and then if you ever get stuck in terms of doing a rebalance, doing a client illustration, you can just give Sean a call and he'll happily talk you through the process as well. As I said, we all work in tandem on the region. So the good thing is if you can't reach me, you've then got Ryan. If Ryan's on holiday or meetings, you've then got Sean, and vice versa. So you'll never be unable to get a hold of anyone from AJ Bell, which is always important because often if you have to contact the sales team, quite often it's kind of urgent as well. So you might be more familiar with Neil Hodge. So Neil's in the bottom right of your screen. Neil's our key account manager here in the South. And then we've also got Brian Donald. So Brian's our investment BDM for the South. He's actually doing a presentation a little bit later on. So I'll leave it to Brian to cover off his introduction then. Now we have got a bit of a broad mix of experience and knowledge about AJ Bell in the session today. So I always think it's worth a bit of who we are and also a bit of an update in terms of where we are as a business. So in terms of AJ Bell, so in terms of who we are, AJ Bell is a FTSE 250 company. We floated on the stock exchange back in 2019. We've got over 1,000 employees against 3 different offices in the UK, the main office being up in Manchester. We've got almost 500,000 now customers that trust us with their investments. And in terms of AUA, we've got just shy of 75 billion under management. And what I really like about that, the AUA, is that as a platforms are all about scale. Margins are very, very slim. So as 74 billion, we've reached that scale where we're kind of a nice, big, stable platform. I think any kind of platforms that haven't reached that scale, there's always question marks about whether or not they're going to be bought or sold to reach that scale. So there's no worries when it comes to us. But not only is a platform do you need scale, you also need to be moving in that right direction and growing. So the good news is AJ Bell is very much a growing platform. And actually, if we look at our last half yearly results, so that's from September of last year to March of this year, number of retail customers is up 7%. And actually, funny enough, the AUA was also up 7% as well. So we're very much a growing platform. And that growth has been all organic. We've not bought other platforms. As I said, that's not our interest. We've not bought IFA practices. It's based purely on the strength of our proposition and how much our customers like us and want to do business with us as well. So during a really difficult trading period, it's really refreshing to see such good figures. And that's so you've got a platform that's off scale, it's all growing, but also that profitability is very, very important. So on that 74 billion, our revenue was up 37%, and more importantly, our profit before tax was also up 61% as well. So again, during a really difficult trading period, it's fantastic to have such strong results, and especially with the profit before tax as well, because there's not many profitable platforms out there, and we have been a profitable platform for a number of years. And we do try and pass on those profits to clients. You know, I'll come to growing price on the next couple of slides, but we do try and operate as efficiently as possible and pass those cost savings on where possible. If we then look at those results in the wider platform market context, this is taken from Platform Report for Q2 of this year. It shows gross and net flows, both as a monetary amount, but also as a percentage. And what I really like about this slide is it shows against our kind of true wrap platform peers how we've had a really strong Q2 this year. Really good, strong flows, but also strong retention as well, and especially during difficult market conditions and during a period when a number of our competitors have really been struggling in the marketplace. So yeah, always refreshing to see. Now, I mentioned about the cost savings we pass on to clients. So obviously price is going to be one of the important areas that we show that. Now, I always think when you look at price, you need to think about value as well, because you can be a cheapest chips platform, but if you haven't got the investments you need, you haven't got the tax wrappers you need, or if their service is terrible, it's not very good value. So I think whenever you look at price, you always need to look at it through the kind of the magnifying glass of value. So AJ Bell, we have two pension products. The first pension product is aimed at your lower net worth clients, and it's an all-in pension solution. So it's called the Retirement Investment Account, or RIA for short, and it's priced at 0.25. It's tiered above that, but there's no charges for setting up the account, transfers in, administration, dealing. It's all wrapped up in that 0.25. It's nice, it's easy to understand, easy to articulate to clients. So that's the first pension product. The second pension product is the full SIP, and that's priced in at 0.2 on a tiered basis again. Now, we have got an admin fee, but we do waive that if the client has over 200,000 on the wrap, and that could be across ISA, GIA, pension. We look at the whole value of all of their holdings. As long as it's over 200,000, we waive that admin fee, but there's also a fee if the client goes into drawdown as well. In terms of the difference between the two products, apart from the price, the main difference is the full SIPs, the one in the middle of your screen, that can be held off platform. So it can be held, if you've got DFM on a bespoke mandate, it can be held directly with them. It can be held in a TIP. It can be held with a fixed term deposit provider, for example. But apart from that, in terms of drawdown functionality, investment choice, it's the same across the two. Plus, actually, because of the same SIP rules, same SIP trustees, it's very easy for us to move clients between the two products, and it's not counted as a full pension transfer as well. So those are two pension wrappers. Any questions on those charges, I'm sure to give me a shout after today's session. Last but not least is the other products, and they're priced in the same as the full SIP, so 0.2 on that tiered basis, but there's no kind of additional charges as long as the trading is occurring inside a model portfolio. Again, any question on any of the charges, be sure to let me know. So you've got growing, well-priced, you've got a growing platform that's profitable. You've also got a very well-priced solution when it comes to platforms. So we all know intergenerational planning is increasingly important in financial advice. It always has been important, but with things like the freezing of the nil rate band, it's become increasingly important over the last few years. AJ Bell, we are a true wrap platform. So in effect, we can house the whole family tree all in that one place. So if you're far left of your screen, for younger clients, you've got access to Bear Trust, Junior ISA, and Junior Pension products. Then as your clients get older, you've got access to GI, ISA, and lifetime ISA products. And the ISA itself is actually flexible. And then as your client's going to get older or more mature, you've got access to charity, corporate, and trust, the GIA accounts. You've got those two pension products I just mentioned, and you've also got link-ins with Utmost, Candlelight, and Quilter when it comes to their offshore bond solutions. So in terms of products, it's about as broad as you can get, and it just means all of your clients can be housed in that one central location without the need to having to dive off to other places. So again, you've got the growing platform, well-priced product, you've got the broad tax wrapper range. I did have a slide on investments, but in the interest of time, I've cut that. So, but in terms of investments, we are whole of market. You've got ETF, you've got access to exchange traded instruments, you've got access to non-exchange instruments, and we said we are whole of market and very agnostic. So there's not much we can't hold. Any questions on an investment side, please come to speak to me, and we can always cover that off separately. But again, if we jump back to that value point, I think the biggest area that we add value, and the thing one of the things I'm most impressed with since joining AJ Bell is our customer support team. I think it's the best I've seen in the industry, and I've got some snapshots and figures from basically July of last year to June of this year. In that time, our customer service team took over 400,000 calls. 93% were picked up in under 6 rings, which I think is a fantastic achievement. And again, jump back to value, it's great value for you and the clients. Neither, you don't want your clients sat on hold for hours, you don't want to be sat on hold for hours. The good thing is with our customer support team, you give them a call, you get through to someone straight away, but more importantly, you get through to someone who knows what they're talking around and owns that query and gets it resolved for you as well, which I think is invaluable. And the same applies for email. So email wise, we took over 600,000 emails and 96% were picked up in under 24 hours, quite often same day, which I think is a fantastic turnaround time. So that's if you need to contact us. The good thing is you don't actually should have that much need to contact us. You know, over 90% of our processes are all done online. So we're very much a paperless business. So most of the processes you can do without having to contact us at all. But the good thing is if you do need to contact us, you can get straight through and get that resolved very, very quickly. That's it in terms of an update in terms of AJ Bell. I also thought it was worth including a slide in terms of what we're seeing in the marketplace, because it's always worth seeing what other advisors are doing and likewise with clients. In terms of what we're seeing, there's going to be no big surprises for the title of the next slide, and that's demand for cash. I think speaking with lots of you, I think lots of you having clients contact you. It's a very difficult environment to have those conversations. You know, clients see really high interest rates, see markets not deciding whether or not they can go up or down. You know, you can understand why lots of clients, especially the more cautious ones, are diving into cash, especially after the beating they took last year around the low risk end. What I think is important though is in that cash conversation, where they do want to go into cash, it's trying to keep those assets on platform. And that's because, you know, when the markets do turn around, they need to be able to jump back into that market very, very quickly. If the money's held off platform, so you know, with a fixed term deposit provider or with a bank, it might be locked in for a period, or it might have to be sold down, transferred back across, and then invested, in which point they might have missed the banks in the market. So the good thing with on-platform cash solutions is the client can very quickly be back in the market without any kind of undue delay. So in terms of the first option, obvious one, platform cash. At the moment, we offer a 3.15% cash or up to. And the good news is we don't charge on that cash position as well. So there's no platform charge on cash as long as it's held on the platform. And again, the good thing about platform cash is, you know, it's easily accessible, easily swept up and invested back into the market. And actually, in terms of 3.15%, it puts us towards the top end in terms of what platforms are paying cash. So that's the first one and most obvious. Next up, over the last 6 months, we've seen a real uptick in terms of interest around gilts. I'm not sure if you're seeing the same, but I think the 2-year UK gilt was one of the most traded assets over the last 6 months. And it's, you know, a good portion is actually the rates available at the moment are quite interesting, especially when you look at comparison to cash, and also the safety of gilt holdings. And also with the CGT changes, you know, the CGT allowance has gone down this year, they're going to go down next year. Gilts being CGT exempt is a huge bonus. And AJ Bell actually really well placed to handle this. Not only can we trade in gilts, but we also have access to the London Stock Exchange. So we trade live on the LSE, which means actually if you phone our dealing team, place that trade, we then place it straight to market, clients invested in a matter of minutes. And that's all for £3.95 per trade as well, so it doesn't even cost very much. So we've seen a really strong interest in gilts. If you have any questions on that or want to talk further, then please give me or the rest of the Southwest sales team a call. And then last but not least, in terms of platform availability of cash-like investments, is your money market funds. You know, very simple, lots of short-dated holdings, close to cash as you can get with that while still being invested. Returns have been quite strong this year, so we've seen a lot of interest in those funds. But again, the benefit is they're held on platform, they're easily sold down, and then can be swept back up into other investments if the client wants to get back into the market. So that's it in terms of the on-platform cash options, but we also have a number of off-platform cash options as well. So these are options that you access via our full SIP. So if you jump back to that price slide, it's the one in the middle, and that's where it can be held on other people's custodianship. So in terms of off-platform, we have access to NS&I bonds, you've got fixed term deposit notice accounts, and you've also got tips as well. So the process is a little bit different, and likewise the charging, because we haven't got custodianship of the assets, our charging does differ slightly. So if you've got any questions on those options, you want to know more details in terms of how you access them with the charges, then please let me, Ryan, or Sean know. We'll be sure to happy to help. And then last but very not least for me is one eye in terms of what's coming down the pipe. Now, we have launched a few things this year, one of which was the one-off Investcentre model, which some of you might have seen, and that's where you can inject money directly into a model portfolio without the need to rebalance. But the biggest thing we've got coming this year, and it's actually launching at the end of this year, we're still just waiting for exact dates at the moment, is our new client onboarding tool. And I've got a few slides to run through with you now. What I would say is that when we've got a date, we will get some training booked in where we can kind of do webinars and show you what the tool looks like. But if you or the team want demo the tool in advance, then please let me or the Southwest sales team know. We can always book in a bespoke session. In terms of the tool itself, you go online, you key in the client's personal details, you choose the tax products they want to invest into, you select the transfers, how much, where it's coming from, is the client in drawdown, etc., etc. Once you've got all those details, you go into the investment section, so you can choose an existing model portfolio. So that could be either be your own or a DFM you can access via the platform. Any ones you've access to will show in a list at the bottom of your screen. You can also then upload a portfolio, something you've done off the platform, or if you want to bespokely invest the client, you can choose individual holdings, punch that into the tool, and at the end, what it does is it gives you all the documents and all the paperwork you could potentially need for this case. So as you can see on your screen, you've got the SIP illustration, you've got the key features, you've got terms and conditions, you've got the kits, all available as a client pack. So if you've already seen the client, you can then easily onboard the client on the next page, or if you've not seen the client, you can then print off that document pack, go out to the client, run through it, sign up the business, come back to your office, hit next step, and then submit the business. And at that point, everything's lodged, transfers are lodged. There's no need for any client signatures or paperwork unless it's a manual transfer. As long as it's through Origo, it's all done online. No paperwork, no need for anything else. It's all done through this one simple, easy to use tool. So that will be coming this year. Again, still waiting for exact dates, but we're really excited, and I think it's going to change a lot of our advisors' lives. And that is it in terms of me. Thank you very much for your content. We've now got Russ Mould. So Russ is our investment director, and he's going to take a look at the markets at the moment and then look at one eye on 2024, and he's also going to run us through his Magnificent Seven and what that means as well. So over to you, Russ.
Hello, I'm Russ Mould, AJ Bell's Investment Director. Greetings from the studio in our London office. I'm going to talk today about the Magnificent Seven, 7 charts on what they might mean for you and clients' portfolios in 2023, and more importantly, beyond. So yes, I'm a big fan of the Magnificent Seven Western, the original one, looking at the screen here rather than the newer version, which was okay, but not quite so good. And obviously we start with Yul Brynner and Steve McQueen there. And then as a pub quiz question, if you can email me and let me know who the other 5 were, then well done to you. But Brynner and McQueen are the dead easy ones. So we're going to very quickly look at what's been happening in the markets this year, because that's what I'm really good at, telling you what's been and gone, because I can read that out of the newspaper. The tricky bit, well, that will come with the Magnificent Seven in the charts to try and help us see what might be coming down the pipe. So in terms of 2022, well, natural gas and oil were the winners. Commodities overall did okay. Gold didn't lose you anything or your clients anything, but bonds and equities found it tough going, and Bitcoin was tail end Charlie. Now, the whole thing's flipped around. Bitcoin's had a pretty good year, though it's been losing a little bit of altitude of late. Global equities have been back in fashion, fired by the US in particular. Gold's hung in there. Oil's now putting on a bit of a wiggle. Natural gas, last year's biggest performer, has been very weak indeed, as Western Europe in particular has found a good job of finding liquefied natural gas and even reducing its energy consumption in other ways, whereas bonds still found it fairly tricky going, as the inflation narrative remains lurking in the background. Now, by equity markets, again, we've probably seen a fairly similar reversal of fortune from 2022 to 2023. So last year, emerging markets were doing well. Brazil and India were the kings or queens of the hill, and the FTSE 100 actually didn't do too badly. The big laggard was NASDAQ, as technology stocks fell out of favor, burdened by lofty valuations, lofty expectations, and rising interest rates. Hong Kong and China also found it difficult as lockdowns persisted. This year, NASDAQ has just gone like Bitcoin, has gone from last to first, helped by hopes perhaps for a pause or a pivot in interest rate expectations, lower valuations, lower expectations, which firms like Meta and Apple have generally exceeded this year. Japan's kept on buzzing along quite happily because it's the only country in the world still virtually with negative interest rates and still plowing ahead with quantitative easing. China and Hong Kong have found it difficult to keep going even after the end of lockdown, and the poor old beleaguered UK has lost a little bit of momentum. So why is this? Why have we seen this reversal of fortune, or what's the big picture drivers for that? Well, firstly, valuations just did get cheaper. Had we been doing this a year ago, and I think we actually did one a year ago, then recession was very much the key theme, and the debate wasn't whether there would be one, but whether we'd get a hard landing or a soft landing. Frankly, now equities are busily trying to persuade themselves there's actually going to be no landing at all. at least in the United States. That's been helped by the fact that gas prices have collapsed and oil has stopped going up, although it's now actually at its highest level in November. That's seen as taking a little bit of pressure off inflation, and in turn taking pressure off these lovely people here, the central bankers who are calling the shots. And again, there is no doubt that the pace of interest rate rises has begun to slow after fairly prompt rates of increase. So as you can see here on this chart, 367 global rate hikes in 2022. The tally for this year so far is nudging towards 150, but we're well into the year, and there have been more rate cuts. Now, in terms of the cutters for this year, it's probably not a company you necessarily wish to keep. The economically unorthodox, such as Turkey, or the economically troubled, such as China and chunks of Africa. But there are one or two more encouraging stories there, such as Brazil and Chile. They were early movers to raise in their fight against inflation, so you could argue they called it better than the Federal Reserve, the Bank of England, and the European Central Bank. And they're now reaping the rewards because they're already starting to cut. So there may be something there for emerging market followers to bite onto in 2024 and beyond, if indeed inflation is under control there and you are starting to see an easing in policy, because they are markets that are still relatively out of favour, as we've seen already. And also, even though we are seeing rates going up, perhaps a deceleration there, central bankers are still trying to tighten policy in another format through quantitative tightening. This is the aggregate balance sheets of the European Central Bank, Bank of England, Bank of Japan, US Federal Reserve, and European Central Bank. And as you can see, the balance sheets are now shrinking, down by about 10% year on year. Bank of Japan is still adding, but the others are trying to make a fist of it and actually withdraw some of the stimulus. The Federal Reserve has now actually withdrawn around a quarter of the stimulus that it pumped in during the pandemic. But overall, their balance sheets are still swollen. The chances of them getting back to where they were in 2020, maybe back to where they were in 2008, absolutely no chance. So although they are still running quantitative tightening, you would still argue, looking at balance sheets in aggregate, there is still lots of monetary stimulus out there and policy is still pretty loose. Something to bear in mind when we go back to talk about that inflation narrative. For all the central banks talking stuff tough, they're still running it fast and loose in other areas. So equities, I think, as we've just discussed, have probably convinced themselves we may get no landing, continued gentle growth, even a return to the Goldilocks economy of steady growth, contained inflation, low interest rates, an environment that did so much to help assets perform across the board, whether it was equities, bonds, or some of the real trash like Bitcoin and non-fungible tokens. I'm just not convinced by that narrative, and that isn't advice, it's just my particular opinion, in that we've just had 15 years, as you've seen on the previous chart, of highly unorthodox monetary policy in the form of quantitative easing, and policy is still loose based on that. Yes, interest rates have gone up, but they're not historically high, particularly relative to inflation. And it just feels a bit pat that after big monetary stimulus, big fiscal stimulus during the pandemic, that we all just go back to where we were and everything's all jolly and nice and straightforward again. It just feels a bit too pat. Anyway, equities think that may be the case, and so far that they're being proven right. But there are three other possible scenarios, and it's pretty easy to make a call for all of them, an argument for all of them, which from your perspective and the client's perspective is tricky, because if history is any guide, then all three require a different portfolio answer, but in terms of strategic asset allocation. History is no guarantee for the future, we must accept that, but it's certainly something that's worth bearing in mind. So what's the case for inflation? Well, as we just discussed, monetary policy is still loose in many ways, and you're still getting fiscal stimulus coming through, particularly in the United States of America, from the CHIPS Act and the Inflation Reduction Act, Bidenomics in short. The trend towards onshoring or friendshoring, to use a nasty neologism, well, that means we're employing more Western workers and fewer cheaper emerging market ones. That just means the goods are going to be more expensive. And energy, we've noticed again that oil is back at its high since November. Uranium is back above $62 a pound. That's up 30% year on year. Energy security may mean that energy gets more expensive, and also because again domestic sourcing. And also we are telling oil companies not to knock holes in the Earth's crust, and they're listening. Their capital expenditure is quite low. Banks aren't financing their projects. Insurers aren't insuring them. So the drillers aren't drilling them. But energy demand continues to go up, and it will always do so if there's economic growth out there. And if demand is going up and supply isn't, Well, 101 economics tells us that that means that energy prices are going up. What's the case for deflation? Well, this is an interesting one. The demise of trades unions has been held up as a reason for, or their emasculation has been held up as a reason for modest wage growth for many years. However, now that employment is low, we can see lots of cases of unions flexing muscles, not just in the UK, but also in the US, where the UAW is now joining the Hollywood writers on strike and demanding some pretty meaty pay rises. So the deflation case could even be moving into the inflation one. But overall, unions do not have the power they had in the 1970s. Overall membership is down, and that is a case for deflation, if not at least disinflation. Demographics, potentially deflationary as people save more through greater longevity. And tech and productivity, well, they're designed to be price crushers. Moore's law in the silicon chip industry, we get the same price, but double the technology, or double the speed and productivity and power in 18 to 24 months' time. That's inherently disinflationary, if not deflationary. And the argument for stagflation, well, debt is still the elephant in the room. It is still going up, and that zombie firms are still hogging capital. Cheap money may have been wasted, misallocated during the boom times of the last 10 years when money was ultra cheap. And a lot of firms that have added a lot of customers, but have never turned them into profit, so they've almost created a profitless prosperity situation. Well, yes, they've been very disruptive, but they've not actually made any money. So they are definitely weighing on prices. It may therefore, if rising interest rates knock some of these firms out of business, that rising interest rates could perversely be inflationary by reducing supply at a time when we're being swamped with the stuff. We shall see. But precedents for all of these, well, inflation, we've seen that in the UK and the US in the early 70s, emerging markets in the 2010s. If history is any guide, you want it to be in real assets, stuff that central banks can't print, which are generally commodities or buildings or land. You probably want to be in fairly short duration assets if nominal GDP growth is good. That's cyclicals, deep value commodities. And maybe if you're really in the mood, index linkers, though I know they are a very acquired taste, and they're a taste that our Chief Investment Officer, Kevin Duran, hasn't got. Now, in terms of deflation, well, this is the direct opposite. Thankfully, cases are rare. The US and the UK since in the 30s, and Japan, maybe you could argue, since the 90s. Then you want it to be in long duration assets because interest rates stay low. You want to be in growth assets because there's not much growth around, and bonds and cash and tech and biotech do very well, thank you very much, in that environment, if history is any guide. Stagflation is trickier. Not many examples, just the benighted UK in the late 1970s. Gold did well, and then you needed pricing power stocks, which generally meant anything could stick down your throat or down the sink, or defense companies. Although the 70s wasn't necessarily a time marked by war other than the Middle East, it was marked by a time of the Red Brigade, the Baader-Meinhof gang and other things, and there was a bit of a mini war on terror going on. So a wide range of outcomes there, all needing perhaps different portfolio solutions. So the question is, how do we spot what's coming around the corner? Because let's face it, central banks don't know. They're the people who said that inflation would be transitory 20 years ago, and they've been proven to be spectacularly wrong. Governor of the Bank of England, Andrew Bailey's even said publicly that the Bank of England's inflation models are based on the last 30 years of data when there's been no inflation. And the Office for National Statistics has just revised its productivity and post-lockdown GDP growth numbers. Garbage in means garbage out. So when central banks say that they're being data dependent, then there's clearly a risk of error there if the data is no good. And also the data is backward looking when they're trying to set policy for 18 to 24 months down the road, because that's how long it takes interest rates to have an effect. So if they're driving the car looking in the rear view mirror, there's a pretty good chance they're going to crash into something eventually. So how do we spot what's coming down the corner? This is where the Magnificent Seven come in, those Magnificent Seven charts. So which charts tell us that indeed we may be going back to the Goldilocks or the disinflationary world? Well, this one does for certain, because it's telling us that tech is back in fashion after its year in the cold in 2022. So this is the aggregate market cap of Amazon, Alphabet, Apple, Meta, Microsoft, Nvidia, and Tesla, or more personally, the year-on-year change in their market cap relative to the year-on-year change in the S&P 500 index. As you can see, frankly, at one stage in the spring this year, those 7 firms had added all of the S&P 500's gain and more, which doesn't say much for the other 493. The good news is there is now more breadth to the American market. Bad breadth is a bad sign. It means too many people are relying on too few stocks. And if anything goes wrong with any of them, then watch out. So a good positive sign going forwards will be better breadth from the US equity market and less reliance on this septet, though a return to low growth, low rates, low inflation would favour them because they are seen as secular long-term growth players almost regardless of the economic backdrop. Back to where we were. I love not just old westerns, but planes, trains, automobiles, ships and trucks, because if they're doing well, the economy is generally doing well. This is Dow theory, where the transports go, the industrials follow, and generally what we're seeing here is that the argument being is that if the transports are doing, the economy is doing well, the transports will do, because if goods are being sold, then they have to be shipped and inventory and shelves have to be replenished. But if the economy isn't doing well, goods aren't being sold, aren't being shipped, and shelves do not have to be refilled. So the good news here is the transports has had a really good run this year. That plays to the maybe we're not going to get a recession at all angle, which is what the equity market's looking for. But as you can see here, the transports haven't yet got back to their late 2021 peak, so the picture might be a bit more nuanced than we think. And then another great economics proxy, silicon chips. Now, you may have heard a lot about the ARM Holdings, the initial public offering in the United States. ARM is a particularly interesting company, looking particularly interestingly valued right now. The good news is the semiconductor index, the SOX, that's Philadelphia Semiconductor Index of 30 global stocks traded in America, has had a thumping run this year, up about 40%. Again, maybe struggling to get back to its all-time highs, maybe losing a little bit of momentum, and this is important for two reasons. The silicon chip industry is a $600 billion a year sales global business. It's plugged into pretty much everything from your smartphones to your laptops, from servers to smart meters to industrial robots to medical equipment to cars, you name it. If the world economy is doing well, chips are selling. If it's not doing well, they might not. So keep an eye on this. And the second reason why this might be interesting is chip stocks are momentum jockey stocks. They feed off upgrades, they're recoiled from downgrades. So they're a great guide to global risk appetite amongst investors. A good run for the SOX. Surprise, surprise, the NASDAQ and the S&P 500 have done well this year when the opposite applied in 2022. So for the equity market to be right, you want it to keep on pulling its socks up. What you don't want to see is the SOX falling down and chip demand starting to weaken. That could play to the soft or hard landing thesis, which is not what equity markets are looking for, but perversely it is what bond markets are looking for. Equity markets are still all believing that there's going to be perhaps no recession at all now, or even a very gentle one, helped particularly in the US by Bidenomics and that fiscal stimulus. Bond markets don't want to know. As we all know, if you lend somebody money for 10 years, you will look to charge them a higher interest rate than if you lend them money for 2 years, because more things can go wrong in between. However, looking right now at both the UK and the US, the 10-year Treasury and 10-year gilt yield is below the 2-year Treasury and the 2-year gilt yield. This is known as an inverted yield curve. It's traditionally seen as a warning of a recession because it's the fixed income market's way of pricing in future interest rate cuts in response to economic weakness. This is a pretty accurate guide normally to recession. The odd false alarm along the way, but not many. But at the moment, it's been inverted for a good year. Equity markets haven't listened, and frankly, economies haven't listened. Even the UK has managed to dodge a recession thus far. The US certainly has. You've got talk of 6% GDP growth annualized right now in the US in the third quarter of this year, according to the Atlanta Fed. But if the bond market's right, there's recession coming. We shall see. Also, another favorite indicator, small caps. They are much more plugged into their domestic economies. They don't have the breadth of management, breadth of product or service to really go too far from their domestic market, and that's why they're seen as a proxy for local growth. The Russell 2000 in the US is putting a bit of a spurt on. FTSE All Cap in the UK is dead as a door knocker, and these indices have done nothing since late 2021, which again doesn't really fit in with the no hard or no soft landing thesis. Now, US small caps again could be benefiting from trickle down from Bidenomics, maybe, but also the reasons that multinationals might be doing so well in the US beside Bidenomics is their treasury departments. They refinanced very aggressively into 2020, 2021, locked in lower rates. So that is deferring any pain from higher interest rates in the Federal Reserve until they refi 5, 6, 8, 10 years down the road. They'll also be getting positive carry because they're getting 5.5% now on their cash. Small caps probably aren't as cashed up, aren't as savvy, don't have the treasury facilities. So that may be one reason why small caps are lagging large caps. We shall see. But I don't like saying it's different this time because you're normally wrong. Bond market inverted yield curve, small cap weakness normally means economic trouble ahead, whatever the equity market's telling me. This is perhaps still the elephant in the room. This points to certainly stagflation, possibly deflation. You know, debt is a killer. And look at the interest burden on the US federal government debt, the red line here, absolutely going through the roof. It's now running at $1 trillion a year annualized. America's tax take is what? $5 trillion? $3 trillion goes on welfare, $1 trillion goes on inflation, $800 billion goes on defense. That leaves $200 billion for education and everything else, which really isn't enough. So America is going to be heavily overspending again. And intriguingly for coincidence watchers, the federal deficit this year will be about 6% of GDP, bang in line with that Atlanta Fed GDP growth forecast right now. So it does feel as if a lot of American growth is coming from Bidenomics and fiscal stimmy. I'm not saying that's going to wear off in 2024, given there's a presidential election coming, but I'm not convinced it's entirely sustainable either. And if you look at underlying US tax take, it's down year on year. The private sector isn't really enjoying itself right now. This is another inflationary or stagflationary warning, perhaps very tricky. If oil really gets a wiggle on, that could put the hammer down. We've seen headline inflation rates come down, but the core CPI numbers really haven't. And it's the core one that excludes oil, food, drink, and things that are obviously really important, but economists don't care about because they're volatile. But if oil gets sticky, then that could drive overall headline inflation up central banks in a terrible bind, because that previous chart really doesn't means that they don't want to push interest rates up for too long. The UK's average interest bill now is about 110 billion pounds a year. If it was a government department, only the NHS would be costing more. That doesn't feel very sustainable or very comfortable either. So central banks probably would quite like to get rates down. And I'm suspecting that in the case of the Fed, that its big gamble is with all of that corporate debt refinancing in 25, 26, their big gamble is they can get inflation down and rates down before that war really starts to hit corporations hard. But oil going bubbly won't help that calculation at all. So where are we? Equities think we're going back to Goldilocks: low rates, low growth, low inflation, no soft landing, no hard landing, happy days. Bonds and small caps are not convinced. They're on recession alert. Commodities at the moment are looking at energy being stronger for longer, and that's a big complication. May even point to stagflation if the deflation eases or the inflation eases, is that right? But it's definitely a big complication. One final chart for you. This is the Bloomberg Commodity Index against the S&P 500 index. If the line is going down, equities are outperforming. If the line is going up, commodities are outperforming. We've just had 10 years of massive equity outperformance. So that's why, again, I'm just intuitively uncomfortable with thinking of, well, we're going to go back to what's worked, because the history shows that isn't necessarily true. In addition, capitalism rewards scarcity. There's not been a lot of commodity exploration capex for the last 5 or 10 years. None at all in the case of uranium after Fukushima in 2011. If there is decent nominal growth and there is further demand for raw materials, there's not a lot of supply growing. That's the kind of thing that capitalism rewards. Whereas in equities, we've had money thrown every which way but loose, courtesy of ultra cheap money. So if commodities start outperforming sustainably, and they had a go at it last year and then petered out, that might just tell us the mood music's changing, and that we're not going to have 10 years of low growth, low rate mush. We might be getting that bit of inflation, with commodities a key part of that. So let's keep an eye on this chart above all of the others. That might be then the Magnificent Eight. Because the original Magnificent Seven were Yul Brynner, Steve McQueen, Horst Buchholz, Brad Dexter. They're the really hard two. Robert Wagner, Charles Bronson, and James Coburn. Thank you very much for your time. I greatly appreciate it, and hopefully see you on the road in the flesh very soon. Thank you.
Thanks for that, Russ. That was a really, really good session. Any questions you may have, and please either put them into the chat box or on the feedback form that automatically load at the end of today's webinar. And next up, we have Rachel Vahi. So Rachel is the head of policy development at AJ Bell, and she's got a session planned around understanding the changing needs of clients and shifting consumer behaviour. So Rachel will spend around the next 20 minutes diving into the FCA's annual Financial Lives Survey, and will provide her analysis on the shift in UK consumer behaviour. It's a hugely valuable insight on the changing needs of clients, so be sure to get your notepad ready because you'll take some notes on this. But across to you, Rachel.
Hello, my name is Rachel Vey and I'm Head of Policy Development here at AJ Bell. I want to talk with you today about the FCA's Financial Lives Survey. Now, this came out a couple of months ago, and it's a really big piece of research that really delves into people's financial lives. The FCA is looking for critical things that are happening and to try and find out how people are coping financially. This is a flagship piece of research from the FCA. It is a massive piece of research as well, and one that they are very, very proud of. It comes in 3 parts. So first of all, there was the Financial Lives Survey, and this is the main bulk of the research results. And this was carried out over a year ago in May 2022. The FCA surveyed over 19,000 people. So you can imagine this is a really big, in-depth piece of research with lots of valuable data. On top of this piece of research, the FCA also did a cost of living survey, and they carried this out in January 2023. And that looked over the previous 6 months to figure out how people are coping with the cost of living crisis. And on top of that, they did some qualitative interviews, and these were carried out in January and February of this year. Now, this all put together, this is a tomb of information and data. This is the 3rd edition that the FCA has done. The first was done in 2017, the next one was done in 2020. So not only is the FCA looking at a whole raft of information, it's also comparing it back against previous years to find out whether there are trends developing or what's changing. There are 3 ways the FCA uses this piece of information. The first is to find out areas of concern or where they think that serious consumer harm is happening. And if that's the case and they find out areas where they think they should be taking action, then they put that within the 3-year strategy. So it's to find out things that they need to take action on. The second way they use it is to look at monitoring FCA policy. So policy changes that they've put into place, for example, consumer duty. They want to see whether that's bedded in, to see whether it has changed things and made financial lives and people's financial lives better. So they want looking at it to monitor their own policy. Third, it fits into different reviews that the FCA is currently undertaking. For example, at the moment, the FCA is looking at retirement income advice, and information coming from this piece of research will no doubt be fed into that sort of review. The FCA is very, very proud of this piece of this research, and they would love it if we all appreciated it as well. They want advisors to read it, to understand it, and to hopefully get a better sense of their financial lives of their customers and their clients. This is a snippet taken from the foreword to the paper. I'm not going to read this verbatim for you, but it goes to show how much the FCA relies on this piece of research and how they are keen that we all read it and to understand the research. And it is an interesting piece of research, so I do urge you to go and have a look. Okay, so let's start looking at the results. I'm going to start by looking at the cost of living additional research, which was carried out in January and February this year. Now, the cost of living crisis is hitting hard for many people in the UK, and there's lots of people who are financially struggling. I do appreciate that advisors, clients have more financial resilience than the general population, and they have the support of their financial advisor to help them through this. But the cost of living crisis is a wide thing. It's a change of society's mindset. We are all very much aware that some people are struggling very, very hard, and it does change the decisions that we all make. There are so many pieces of statistics and data I could have picked out of this research to show you. So I've only just limited it to just a few. 77% of people said they were finding it difficult to keep up with bills and credit commitments, that times was tough. And 11% said, actually, it's worse than that, I'm in financial difficulty. And that's up from 8% when the FCA last asked that question. So I think that's really indicative of how many people are struggling in the UK. Another statistic is that 71% said they had no disposable income. So they had no money left over at the end of the month to save or invest or to put aside for the inevitable rainy day. And I found it quite stark that half the people they surveyed said they had stopped, or they had reduced their savings, or they had dipped into their savings or investments. And I think if you have a low financial resilience anyway, that just shows that times are going to be very tough for people, and then just not able to save anything else. The Treasury and the FCA are always keen to find out how people are coping within the current cost of living crisis and what that means for their savings and for their pensions. 6% have stopped or reduced their pension contributions, and the survey found out as well that 6% had fully encashed their pension or taken out a lump sum to help ends meet. Now, if you really want a good indication of what's happening with savings and with pensions, then looking at the automatic enrolment opt-out rate is probably a really good place to start. In August last year, in 2022, this was 10.4%. Now, this was a really big increase up from the previous data, which was January 2020, which was 7.6. So 7.6 up to 10.4 is quite a big step. I think it would be really interesting to know what the current opt-out rate is and whether this is creeping up more and more. The silver lining with all of this is that retirees are generally, they're coping okay. Financially, they're all right. And that's because a lot of them are receiving or in receipt of a fixed income or an income that is linked to inflation. For example, many retirees are still receiving a defined benefit pension. And so that is going to be linked, or maybe linked to inflation or a steady increase. And of course, if they're receiving the state pension, then because of the triple lock, they are enjoying very good increases to that state pension. Now, that was 10.2% increase last April, and we just got news that the increase next April is likely to be 8.5%. So 10.2% one year, 8.5% another year, which is very, very sizable increases. Now, whether that means that we need to have a review of exactly how the triple lock operates and whether it is appropriate, I think that is probably due now. And I think both political parties are maybe going to signal that they're ready to have that discussion. So let's move away from cost of living crisis and look at the main body of the research. The FCA was keen to look at consumer duty. And what it's doing here is it's setting a benchmark. It will carry out another financial life survey next year in May 2024 to publish the year after. So what they're looking here is to compare results against last year's and next year's and to figure out where things are changing. Now, they're looking across all financial services firms. So it's not just platform companies or pension companies or savings. It is across the whole range of financial services firms and customers. They looked at customer support. Only half the people said that they had actually claimed some customer support and got in contact with some customer support. But where they did, 84% said, yeah, it helped. It was good. It worked for me. The FCA also looked at whether the products were meeting the customer needs. A lot of this is going to be focused on value for money and whether charges are too high or whether it did what it said on the tin. But it's also to do with shopping around. The FCA is always keen to understand whether people are shopping around for their financial products. Now, I thought it was quite interesting that within the research, the FCA looked at whether people were shopping around for how easy it was to shop around. And in one bit, they compared pet insurance. Shopping around for pet insurance came out as 90% of people found it easy to do that. But they also said that only 68% of people found it easy to shop around for income drawdown. Now, I find that quite a juxtaposition to put forward. I'm not entirely sure it's the same process to shop around for those two different financial services products. The FCA also wants to look at communications. 27% of people didn't find communications helped at all when making a decision. But on the other hand, 20% said yes, it did help. So I think there's just a range of responses there. What is interesting is that for vulnerable customers, that figure of 27% increased to 40%. So vulnerable customers or customers with vulnerable characteristics are struggling a little bit more with communications and support and getting the right sort of product. And that is very apparent all the way through the FCA's research and looking and what they have said about their research. As you've put consumer duty implementation into place, I'm sure that you've looked at your vulnerable customers and how they are coping and to make sure that there are solutions available for them. And I think this is one angle that the FCA is going to pick up on as part of its implementation review. Okay, so turning now to trust in the industry and the provider. Well, the trust in providers and the industry is not spectacular. Only 4 in 10 people said they've got confidence in the UK financial services industry. And I thought it was quite damning that only 1 in 3 thought financial firms were honest and transparent. When the FCA dug a little bit deeper in the qualitative interviews to find out why people's trust and confidence was low, then people cited things like the banking crisis of 2008 and bailing out banks and bankers' bonuses and PPI mis-selling and things like that. And I think that what this goes to show is that these set pieces live long in people's memory, and that's really the general perception of the industry, and it's going to take a long time to row back from that. However, when the FCA asked people about their trust and their confidence in their own provider, specifically their own provider, they were generally happy. Now, I've included some data here for looking at some different financial services products, some annuity, mortgage, income drawdown, cash ISA, and a DC pension. But as you can see, these figures are generally really high. People had either high or moderate satisfaction. So they maybe had a problem with the industry, but not with their own provider. How did they view their advisor then? Well, I think these are really positive figures. You can see from the bottom 3 graphs the level of trust and satisfaction that people have in their financial advisor. So all this data is taken from people who work with a financial advisor or have received financial advice over the last 12 months. And generally the levels are really high. So where they do get financial advice, it's working out well. People trust them, trust their financial advisor, they've got high levels of satisfaction, and they've got confidence in the advice plan that they have been set. Looking at that 19,000 people that they surveyed, only 8% had received regulated financial advice in the previous 12 months. And the number that were receiving it from a financial advisor firm had remained steady over the last few years. Where there had been a slight increase is the number of people who were receiving online advice, and that had increased 8-fold. Now that sounds spectacular, doesn't it? But it is only 800% increase on a small number is still a small number. So it's still only about 1% of those surveyed. But it does show that it is increasing slightly in some areas. The FCA went on to ask why people like advisors and why they trust their own advisor. Now, if you're looking to build your client bank and you're looking to review your communications and how you position yourself as a firm, then this slide might be of interest. It shows that people really appreciate the FCA regulation and the safety net that gives, that they're looking for a brand or reputation that's really quite high, and that professional qualifications are crucial. And I think that all stems towards building a really good, solid profession. Recommendations are also key, whether it comes from a friend or a family or an accountant or solicitor. So maybe including testimonials within websites and the way that you position your firm is really useful. I also wouldn't be too quick to dismiss things like Google reviews. It could be that people really rely on these to figure out how other people like them have experienced the firm and have experience of the firm. So I think these things are really important. So people who are using regulated financial advice, who are getting regulated financial advice, are generally very happy with it. And I think that's, as I said, I think that's really positive. But the FCA was also keen to find out how people who don't receive it, but should receive it, view financial advisors. Now, the FCA looked at their survey and they reckon 28% of the people surveyed should be getting regulated advice. Now, this is their definition, but their definition was anyone who had more than £10,000 in investable assets or had more than £10,000 in a DC pension and was within about 2 years of making a decision about what to do with that money. Now, what they found with these people, they asked them about if they thought financial advisors were unbiased, whether they trust financial advisors to act in the best interests, and whether they think they are professionals. And you can see from the top 2 columns, those are people who agree with those statements or slightly agree, strongly agree or slightly agree. And I think it's a bit of mixed views, really. I think that the fact that they do view, and over half the people view financial advisors as a profession, and it's a strong profession, is really positive. But there is probably some work to do in other areas to knock down barriers. So one of the areas the FCA is very keen on is to make sure that more people receive support and guidance when making decisions. They have set up an advice guidance boundary review. And this is looking at this magical line just between what is given, when a communication is guidance and when a communication is advice. And the concern about some providers and employers about not overstepping the mark and not, for anything they say, straying into advice. So the FCA is going to give us a lot more information about where that boundary lies to hopefully help people, to help providers and employers give communications that can help people and support people in making decisions, but is not regulated financial advice. But they also need to look, I think, wider than that, and to look at closing the help gap within the UK to make sure that more people receive support and guidance. Now, part and parcel of that response and that solution has to be increasing the access to regulated financial advice. But there might not be many people out there who want to work with financial advisors or can't find a financial advisor to work with. And there is a question whether advisors have the capacity or the desire for new clients as well. The FCA is also keen to make sure that the people who do need support and guidance get it. So one of the areas they're looking at is how do they support and how does the industry support people making decisions. Together with the Treasury, the FCA has set up a review of the advice guidance boundary. Now, they're looking partly at the line between what a communication is, whether it is advice or whether it is guidance, to make sure it's very clear which side of the boundary and which side of the line it would fall into. And this is to give comfort to both providers working directly with customers and also employers to make sure that they know what they can say to customers or their employees when they're making decisions, and to be confident that they're not straying into regulated advice. But this review has turned into a much bigger piece of work, and it's now looking at how to reduce the help gap to make sure that people get support from when they are making these big decisions. There are several things that the FCA and the Treasury are pondering. Now, one of these is simplified advice. You might remember that last year the FCA issued a consultation on simplified core investment advice, looking at how to give simplified advice around a stocks and shares ISA, where you look at a reduced fact find and just focus on giving advice at that one particular point, just on transaction, not on ongoing advice, and whether that would work in practice. We did some research with advisors and asked if these FCA proposals would fit into their business model, or it's something that they would like to expand to include within their business model. And 93% of advisors we talked to said, no, this just simply does not work for us. Now, I'm quite relieved that the FCA has decided to drop these proposals for the meantime, and they've decided not to go ahead with that particular bit of the consultation. However, they have rolled the proposals into this broader advice guidance boundary review, and to see whether simplified advice could play a part. If it does, then it has to fit into advisors' business models, and it has to work on that basis. There are other things that the FCA and Treasury are looking at. One of them is regulated guidance, whether that's regulating the people who are giving a certain level of guidance or what that guidance says. But it's looking at exactly how to give more personal information, but again, not straying into regulated advice, but giving them more information and more support than currently get. Part and parcel of this has to be including and widening out access to financial advice as well, and regulated advice. And I think that's an important part of the proposals that the FCA and Treasury should be looking at. Finally, the review is also considering pathways. So looking at the progression of someone's decision making, and whether they can say whether they chose decision A, then decision B, then decision C, will give an output at the end of what you could say to someone. And I think that is a little bit more, needs a little bit more work and consideration. It cannot be too restrictive or too contained, because people's lives don't work like that. It's much more nuanced. So I'm not entirely sure whether pathways could work in practice, but we need to see what the FCA and Treasury are proposing. And hopefully we will get a consultation or a discussion paper on this in the next few months, certainly before the end of the year. Turning now to look at specific savings and investments. Let's start with pension saving. The FCA wanted to know how many people were saving within a pension, and the answer was, of all the people who were not yet retired, 67% of them were building up a pension. The people who weren't were people who were unemployed, or they didn't earn very much money, or they had opted out of automatic enrolment, or the self-employed as well. And I still think there's quite a bit of action that the DWP and probably Treasury and government in general need to take to encourage some factions of the self-employed to save more for their later lives. The FCA also asked people who were saving, how much are you saving? You can see from the graph that it's banded into different pot sizes, and that the majority of them haven't really built up a very big pension pot yet. And I think that's understandable. Automatic enrolment is still in its relatively early days, and obviously as time goes on, these figures will increase, especially as now we know that the lower earnings age is going to be reduced from 22 to age 18, and that it's going to contributions are going to count from the first pound of earnings upwards. So these are both positive things that have happened, and these now just need to be implemented within the automatic enrolment rules. There are a couple of stats here which I found quite alarming. First of all, just under 1 in 10 people didn't know whether they were building up a pension or not. Now, I'm a strong believer in automatic enrolment and in the power of apathy, but I find that a little bit alarming. I think if you are in a pension scheme, even if you didn't choose to be there in the first place, you should know about it. The second one is people who don't know how much they have got saved. Now that was 30%, so 3 in 10 people just couldn't put a figure on how much they had saved within a DC pension pot. I realise that there is an element of cynicism about Pensions Dashboard, but I think it could be a very strong motivator to increase engagement between people and their pension savings. Now, if we can encourage them to go onto the pensions dashboard and to pull the data towards them, then they can find this out and maybe find out they've got more pension pots than they knew about and more pension savings. How do people take their pension pots? Well, again, the FCA wanted to understand that, and I think these graphs probably reflect what you know is happening already. A lot of it is partial encashment. People are maybe dipping in and out of their pension pots to take a little bit of cash or a little bit of income drawdown at times when it really suits them to do so. 1/4 of those who had access to their pension pot was still working. Now, I found that a little bit on the low side, but it may be with our financial advisor clients that this figure is a little bit higher. These are the sort of statistics that are going to feed into the FCA's review on retirement income advice. Turning now to look at investments. The FCA asked people, do you invest and where do you invest? So the answer was 41% of people said, yeah, we have investments. And it covers the broad range of everything that you would probably expect, really, and where you think that people would probably invest their money. What I found was quite interesting was a little slot which the FCA included, a little bit which they drew out and have focused on younger people. Now, those people who are aged between 25 and 34, there had been an 11% increase in the number of that age category investing. So that's really quite a big jump. And there was more men who had increased their saving than women. I think this relates to the increase in high-risk investments and the fact that that had doubled to 8%. And when the FCA looked at investment in crypto assets, they found that had gone up threefold. So quite considerably more people are investing in these type of investments. The FCA dug a little bit deeper and asked people, why are you investing in these products? Why are you investing in these type of investments and crypto assets? And they gave them a range of reasons why. And 85% of the people chose quite an emotional reason. For example, they said it was challenging, or it was novelty, or it was fun, or it was a gamble, which I thought was very worrying. But I think what this shows is that we've got a new cohort coming forward of risk-hungry, emotional, maybe men who want to look at these particular assets and want to invest in these particular things. And I think the FCA this will cause a few sleepless nights for the FCA to figure out how they can support these people in taking this investment. I want to end on a positive note by looking at pension investment scams. Now, the pensions cold calling ban came in quite a few years ago, and there is now proof that it is beginning to work. In 2017, 22% of people received an unsolicited approach, but that had fallen to only 9% this time round. So I think that's really positive that fewer people are receiving these approaches. However, out of those who did, 8% responded to the approach and 3% lost money. Now, one pension scam it's one scam too many. So the FCA needs to really keep on top of this. The FCA and the government need to keep aware of how pensions and investment scammers are working. Because if one thing is guaranteed, once you think you know how it's all working, and once you think you know what the model is, that's the time when the scammers change it. So in summary, the Financial Lives Survey is a key bit of research from the FCA. It is very big and very comprehensive. There is a lot of data there, and I do urge you to go and have a look, because I do think you will find some elements of it really interesting and pertinent to your clients' financial lives. The FCA is looking at it to monitor consumer duty, and it's obviously looking for results to be positive next time round, to show a key difference and to show that the dial has moved. Generally, people don't trust financial services, but they do trust their provider. I think there are some issues still remaining around how many people are accumulating pensions and how many people just don't know how much they've got in their DC pension pot. And obviously investment in crypto assets is a key concern for the FCA, and I would expect them to continue to look at this area in depth. If there is one positive message I would like to end this with, is that the people who do receive regulated financial advice do see its worth and do have trust and confidence and satisfaction in their financial advisors and their financial advice plan. And I think that's a lovely positive note to end on. So thank you very much for your time. If you do have any questions, then please feel free to get in touch. Thanks. Bye.
Wonderful. Thank you very much for that, Rachel. Again, any questions, please pop it into the chat box or use the feedback form within today's webinar. But you will all be pleased to know there's now a break session planned. So please put your feet up, grab a coffee, and get excited for Brian's session all around AJ Bell investments. Welcome back, everyone. Hope you're all strapped in. Next up, we have AJ Bell's investment BDM, Brian Donald, and Brian's got a really quick update around the AJ Bell investment range, including performance. Over to you, Brian.
Hello, I'm Brian Donald, Investments Business Development Manager here at AJ Bell. And for today's session, I'm going to be running through an overview of the AJ Bell Investments proposition and an update on performance. So let's get started. So our investments business has been going since 2016. And as you can see from the chart, we've now reached AUM of 4.3 billion as at the latest reported figures. And that was up 72% year on year. So strong inflows, and with that scale comes economies which we will look to continue to pass on in terms of lower investment costs for clients wherever possible. Our investments business has been going since 2016, and we've seen strong AUM growth and increasing inflows from advisors. In the last set of published numbers for the year to 30th of June, our assets grew 72% year on year, reaching 4.3 billion. So a big thank you to everyone watching who has supported us. Of course, there is a benefit to increasing scale with the pricing that we can potentially obtain on the underlying funds that we use. And if you look at the history of our OCFs, they've been coming down, and we will continue our commitment to you to bring down investment costs wherever possible. Now, just to recap on our investment range, we run a range of multi-asset portfolios, and we offer plenty of choice in the range to meet different client objectives and preferences. So we can slot into your CIP for a variety of different client segments. A central feature across all of the portfolios is active management of the asset allocation. So starting with our growth range, we are risk targeted, and we use Distribution Technologies Dynamic Planner. So our portfolios are managed to always stay within the DT volatility corridors, which means that they're going to behave in a predictable way. We have a portfolio for each of the middle 6 DT risk profiles. So DT3 through to DT8 lines up with our MPS 1 through to 6. We then offer 5 different versions of implementation, and this relates to the type of funds that we're using to build up the portfolio. So in our passive MPS, we use passive funds, and that's our lowest cost option. In the active, we're using predominantly active funds, and Pactive offers a blend of both active and passive styles. We also have our responsible MPS range for clients who wish to prioritize ESG considerations. And then finally, we have our growth fund range, which offers a very similar set of portfolios to the passive MPS, but in a unitized format, i.e. a fund of funds. An additional responsible growth fund completes the range. And just to reiterate, all of these implementations still all benefit from active management of the asset allocation. So even when we talk about a passive MPS, what we mean is a portfolio which is actively managed at the asset allocation level and then implemented using low-cost passive funds. For income investors, we have 2 risk profiles, income and growth, both of which target a yield of 3 to 5%, with the income strategy focused on maintaining capital, whilst the income and growth, as the name suggests, has an objective to grow the capital. We have 3 different implementations to choose from here, with the passive and the active MPS, and also the funds. We also offer our retirement portfolio service, or RPS, which is designed as a centralized retirement proposition to manage sequencing risk in drawdown and is delivered in a simple, transparent and easily understandable format. The overall objective of the RPS is to pay out a sustainable income of 4% to customers, uplifted in line with inflation and based on the initial sum invested, although the income may be withdrawn flexibly. It is designed around three easy to understand buckets. The income and the income and growth fund form the medium and long-term assets via 45% allocations. And then we also have a 10% allocation to cash. The income and income and growth funds each produce a natural yield in the range of 3 to 5%, and the 10% cash allocation negates any risk with regard to the first couple of years' worth of income. The allocation between the three buckets is rebalanced according to a set of rules which are algorithmic in nature, with the aim of further reducing sequencing risk. The RPS is accessible only on the Investcentre platform and can be used with pension, ISA or GIA pots. Moving on to costs, our funds are priced with a fixed OCF, which starts at 0.31%, which is inclusive of our management fee. And we believe this to be very competitive in the market for a multi-asset fund range with active management of the asset allocation. On the MPS side, our OCFs are also very competitive in the peer group. We have one of the lowest AMCs at 0.15%, and that's irrespective of the implementation type. And again, the OCFs quoted here on the slide are all inclusive of the 0.15% AMC. And then for completeness, on this slide, we've also got the transaction costs shown below the OCFs. And now just a word on platforms. In addition to our own AJ Bell Investcentre platform, we've been expanding the range of third-party platforms where our MPS is also available, most recently with the addition of Transact and Hubwise this year. We continue to expand our reach, recognising some advisors' desire to run a consistent CIP across multiple platforms. The aforementioned Retirement Portfolio Service, or RPS, is available solely on the AJ Bell Investcentre platform. So now turning to the performance and looking at the returns over 1, 3 and 5 years. Over the last year, persistent inflation and rate hikes have meant that bond-heavy portfolios have struggled. However, our high-yield bond allocation has helped, with high-yield debt being the best performing part of the bond market. Emerging markets and Asia-Pacific ex-Japan equity asset classes have been held back by the underperformance of China. And this has been felt the most in MPS 6, which contains a high weight to those regions. So as a result, MPS 5 has been the best performer, containing the most developed market equity, not so much in China and owning high yield bonds. Over 3 and 5 years, the portfolios have performed broadly in line with risk taken, with the exception of MPS 6, although the recent China underperformance has less of an effect in the long-term numbers. Moving on to the active range, looking back at performance, it has lagged the passive equivalent, with the exception of the income portfolios, where the ability of active managers to invest more broadly than the indices has led to outperformance over some periods. This reflects a difficult environment for active managers in recent years. However, AJ Bell remains agnostic on the active versus passive decision, and we offer both options, and we also offer our blended option, the Pactive. And looking at the past performance of the Pactive range, that sits in between the active and the passive. Moving on to the active range, looking at performance in general, it has lagged the passive equivalent, with the exception of the income portfolios, where the ability of active managers to invest more broadly than the respective indices has led to outperformance over some periods. This reflects a difficult environment for active managers in recent years. However, AJ Bell remains agnostic on the active versus passive decision, and we offer both options, as well as our blended option, the Pactive. And then just completing the picture, we have the Pactive returns, which sit in between the active and passive. Relative to the peer group, we are performing well, and if you look at the Morningstar report, which has just come out, their annual NPS market reports from their NPS database, which is quite extensive now. AJ Bell Investments had 4 passive portfolios and 1 active portfolio, which were in the top 10 performers in their respective equity categories over 5 years. So competitive performance in the peer group. As I mentioned earlier, our fund range is essentially a unitized version of the passive NPS, but there are some differences in the implementation. Performance has therefore been broadly similar, and relative to peers, we continue to perform well. Looking at the quartile rankings of the funds in their respective IA sectors, over 3 years, all the funds are above average in their respective IA sectors, and over 5 years, they're all in the top quartile in their respective IA sectors. So again, competitive performance in the peer group. So that concludes my short session for today. In summary, we continue to grow and continue to endeavour to bring down our costs where we can as we get increased scale, and our performance has remained consistent and within expectations, and we've been competitive in the peer group. So thank you for your ongoing support, and thanks for watching.
Excellent stuff. Thank you, Brian. If you want to hear more about the range of investments or managed portfolio solutions, then please let us know in the feedback form or in the chat below, and we'll be sure to come back to you. And now our final speaker of today, and very much saving the best for last, is our senior technical consultant, Lisa Webster. Lisa will be examining how pension lump sums and death benefits will work in the new pension world of 2024, and we'll discuss planning points under the new regulations.
Hello and welcome to this session on life after the lifetime allowance. So we had a bit of a bombshell, I think it's fair to say, back in March with the budget announcement. I don't know about you, but it certainly came as a bit of a surprise to me, and I think most of the pension industry. The fact that the lifetime allowance was going to be abolished completely. We'd heard rumours that it was going to be cut, but it going completely was a bit out of the blue, and certainly without consultation with the industry. So we've got a lot of changes coming about. We've had lots of questions on it. I'm sure you've had lots of questions about it too. So really, yeah, the idea of this session is to go through what we know so far in terms of what's happened now and what's going to happen in the future with the lifetime allowance. So I'm going to start off by just having a bit of a recap of the rules for the current tax year. So it's a gradual process that's happening. So we've had a set of rules come in this year. We then will have another set of rules that come in from April 2024 and beyond that. So we'll look at what we know, some of the information that we have already about that, what that's going to look like. I'll talk about protections a little bit. So, what the impact is for clients with protections in the new world. And then I'll look at some of the questions that we don't know the answers to yet, which there are a few. So yeah, just to acknowledge, I'm sure there'll be things you're getting asked and certainly things we're getting asked that, yeah, we don't know yet. So kind of trying to determine what we do know and what we don't know. So a bit of a timeline to start off with then. So it all started in March with the budget announcement. Obviously, there was lots of headlines about it, but the lifetime allowance is being abolished, swiftly followed by Labour standing up and saying if they get into power, they'll reintroduce it, which obviously makes life more interesting as well. See, what we're talking about today is really, how it is going to be removed, dealing with that might impact how, if ever, they did bring it back and whether they actually will. I think there's still some debate about that, really. But anyway, yes, so we had the budget announcements in March, and then it was about a week later we had our draft finance number 2 bill for this year. So this is where it set out the rules, which then came into play from 6th of April this year. So finance bill came into effect from the 6th of April this year, although it didn't actually get royal assent until the 11th of July. So, we had a bit of a temporary period where we were working off draft legislation for a few months, and it could have been subject to change. And there were a few sort of minor tweaks around the edges, but nothing major. But, it is fixed now for the position for this tax year. So I'll go through what it is, what the situation is for your clients who are crystallising, taking benefits this year. We then, on the 18th of July, we had our first look of what really life after the lifetime allowance looks like, will look like from April next year. So this is some clauses that were released, which will go into the next finance bill 2024. It's not all of the finance bill, it's only the bits relating to the removal of the lifetime allowance, and it is not all of them, it is just a bit of it. So that is open for consultation. Maybe by the time you're watching this, it might have closed, but it closed on the 12th of September, this consultation on the draft clauses. So that's, as I'm recording this now, is what I'm looking at. We're in this consultation period. So the rules that I will go through about what we know from these draft clauses are still subject to change. And as I've said, they're by no means complete. So we are expecting further legislation to tell us a bit more about the rest of the rules, the bits that are missing, possibly November. We think it might come out around then. It's not set in stone. And then, there'll be a consultation on that. And then we should get a finance bill usually around March time, which should be the complete finance bill. Which isn't really very far ahead of the changes, which are all meant to come in April 2024, is an implementation date for these new changes around the removal of the lifetime allowance. And again, still will be a bill, so there could be little tweaks in it right up until it gets royal assent, which is normally do it in July, just before the summer recess, whereas then definitely are not going to get changed. Until they make some new legislation. So we'll start off then by looking at, say, the situation for the current tax year. So this might be a recap for some of you, I'm sure, but just a quick sort of reminder, if you like, of what's happened. Because of course, when the budget came out, it was very short notice for from middle of March till the 6th of April. The intention's always been to remove the lifetime allowance, but there just simply wasn't enough time to do it. So we've had these temporary measures in place effectively for this year. So not massive changes in terms of the process and what goes on around benefit crystallisation events. We still have our lifetime allowance in place this year, frozen at the level of £1,073,100. We still have maximum PCLS payments of £268,275 for anybody who doesn't have protection. We still have our benefit crystallisation events, and we still, as a provider, we still have to issue BCE statements when somebody takes their benefits. So the process that we go through hasn't changed at all. So we still need to ask clients about their previous lifetime allowance usage, and we still have to ask them if they've got any protection and for evidence of any protection when they come to take benefits. We still have to do all the tests. We still have to do 875 tests, though given the fact at the end of all that process that we do, the same as we've always done, there is no lifetime allowance charge. So part of it might seem a little pointless, especially to your clients, that that we have to go through this process, but at the end of it, there's no charge. However, when we come on to sort of look at the rules for next year, there is maybe a point still why we have to have statements and things, why we might still need to know this going forward about what benefits people have taken previously. I say this is all law now in the Finance Act, which has now got royal assent for this year. Now, there's no lifetime allowance charge, say, in the current year, but there's a little bit of a caveat on that. So anywhere that we had the 25% lifetime allowance charge previously, that has gone. So that was really when people are taking income. So most common one will be people, certainly for us in SIP world, people who are using funds in excess of the lifetime allowance for drawdown. So basically, that's where we used to have a 25% lifetime allowance charge. The funds would remain within the pension, but when they come to take it, they pay income tax on it. That 25% charge is gone now. They just pay the income tax when they take it out. Same at age 75 is the other one, is the main one on this as well. A lot of people would only designate funds to draw down up to the LTA before 75. Obviously, some people did the excess before that, but not always. But you couldn't avoid it by 75. So, quite often on age 75 tests for those in excess of the lifetime allowance, we would have to deduct the lifetime allowance charge from their fund and pay that across to HMRC. We don't have to do that in the current tax year, so that is fine. But where it's the slight caveat is with where a 55% lifetime allowance charge would have applied previously. So these are the ones where it was paid out as a lump sum, because obviously with a 25% lifetime allowance charge, it was still within the pension, and they would then still pay income tax on the way out. Whereas with the 55% lifetime allowance charge, that was it. There's one tax hit, which is why it was a higher rate, because there wasn't income tax as well. So in the current year, basically anything above the lifetime allowance taken as a lump sum, you don't pay the 55% tax charge, but on the bit above the LTA, you now pay income tax on it. So in the lifetime, that would be a serious ill health lump sum. The more common one would be the lifetime allowance excess lump sum. So if you take that as a lump sum now, you just pay income tax, but if you take it as drawdown in our world, you just pay income tax. There's not really much difference on that. And then, yeah, uncrystallised funds, lump sum death benefits. So you've got the death benefit ones as well. So the death benefit, it'll be subject to income tax in the hands of the recipient, as of the beneficiary who's receiving it, if it's above the lifetime allowance. In those cases, the scheme administrator would still pay it out in full to the beneficiary. They would report the fact it was over the lifetime allowance to the personal representatives dealing with the estate. They'd tell HMRC about it. HMRC then go and get the income tax directly from the recipient of that lump sum death benefit. In those cases, probably not that common, but certainly not in crystallised funds one in DC world, maybe a bit more in DB, you might get some on that. The other change for the current tax year is around when we look at protections. So if you've got clients who've got enhanced protection with protected PCLS, there are some changes on this. So if the protection was in place on 15th of March 2023, the date of the budget, technically it's whether it had to have been applied for by that date. If it was later received, that's fine, but with enhanced protection, you've probably had it for a very long time, as it's going back to 2006. For these people, so your clients that hold enhanced protection, big difference is now from 6th of April this year, they can now make contributions. So obviously they can't have made contributions in the past because it would have broken protection, any contributions that they've made since 6th of April back in 2006. So they've had a long time where they couldn't contribute. They can now contribute, and they will still retain their right to protected PCLS. Whatever it says on their certificate on there. However, there is a cap on this. So the PCLS is capped at the maximum that was available on 5th of April 2023. And that is regardless of whether they contribute or not. So I guess they've done this so that, people in this situation can't suddenly put lots into their pension. if they are still working and they've got the earnings to support personal contributions, or they've got an employer that can make contributions, obviously they'd have maximum carry forward available because they can't have contributed for years, that they can't just put it in and then get more PCLS as well. But it does apply regardless of whether they contribute. So I think the only sort of real losers in this would be if somebody had enhanced protection with protected PCLS and they come to take it in a couple of years' time. They've not made any contributions. Before these rules came along, they would have been able to take their protected amount, the protected percentage of the whole fund, whereas now it's only the maximum available at 5th of April 2023. So basically, they're not getting the PCLS on any growth after the 5th of April. So an example on this one, let's say you have somebody had lump sum protection of 30%. Their 5th of April value was 1.8 million. Their max PCLS entitlement now is capped at 30% of that 1.8 million, so 540,000. When they come to take their benefits, the max PCLS will be the lower of whatever it is they're crystallising and 540,000. So, if their fund value was £2 million when they came to take it, they'd only be able to have £540,000 PCLS, whereas before this rule change, they would have been able to have 600,000 if the fund value was 2 million and 30% of that. So there is a change on that. But as I've already said, yeah, the entitlement remains whether they contribute after 6th of April or not. Another change is for those people with fixed protections, any of the versions of fixed protections, so long as they had them in, well, I've said it here, in place on 15th of March 2023, but again, it could be because applications are still open for the latest version of fixed protection, so fixed protection 16. You just have to have applied for it by the 5th, have your application in before 15th of March, and if it's granted later, it still applies. Basically, for these people, they can now contribute from 6th of April again, from the start of this tax year without impacting their PCLS. So that's quite a big change. You're going to have people, probably more people with fixed protections who haven't started taking benefits. You have people that can, and they're more likely to be younger and still working and still have the ability to make contributions, that they can now do that without impacting their PCLS. They will still keep their protected PCLS going forward. This is particularly good news for people who've got divorced. If you have any clients who have enhanced or fixed protection, who have had a pension sharing order applied to their pension, so it has reduced the value of their pension, but it's not reduced the fixed protection to the point that they've lost it, so they still have fixed protection, but their fund values have gone down. But they can now rebuild their pensions. They can without losing their entitlement to a high level of PCLS. So that could be one, if you have anybody in that scenario, worth looking at. So PCLS calculations, I've said PCLS calculations remain the same for these people. Just a little look at what I mean by that. So this is where people had protection in place, already applied for it by 15th of March 2023. Anyone that had enhanced protection but didn't have lump sum protection, their PCLS will remain as the lower of 375,000, which is based on the old 25% of 1.5 million when the LTA was introduced, and 25% of the amount crystallised. But they can include any contributions post 6th of April 2023. So the cap of 5th of April 2023 value for PCLS only applies to enhanced protection with lump sum protection. It doesn't apply to anything else. So yes, if somebody's fund value is less than 1.5 million, they could build up to that value and increase their amount of PCLS. Fixed protection 2012, because that was based on 1.8 million. So the PCLS maximum on there is 450,000. Fixed protection 14, again based on 1.5 million, so PCLS is 375. And then finally, the current still open, the fixed protection 16, PCLS will be the lower of 312,500, so that's based on the 1.25 million and 25% of the amount crystallised. And again, if people have got lower fund values, you might have FP 16, your fund value might be 1.1 million. you know, you've got a bit of headroom there. You can put it up, make contributions now, get it up to the 1.25, and then have a higher amount of PCLS available on that. In terms of other protections then, so basically primary protection and the individual protections, there's no change in the current tax year because you were always allowed to make contributions with these. That didn't break it, so that's still the same. Your PCLS payments are still the same as they always were. So for your individual protections, it's 25% of whatever your protection amount is, and primary protection is based on 1.5 million, so 375,000 if there's no lump sum protection with it. Yeah, so they stay exactly the same as they are now, so there's no change on those ones. So that's where we are for the current tax year. Looking forward then to what happens from April 24, which is when the lifetime allowance is actually going to be removed. At the moment, it's just the lifetime allowance charge that's removed. So the proposed revisions that we've had out then is we had 41 pages of draft legislation come out, and you know, just on removing the lifetime allowance, which gives an idea of the size of the task. Also, the fact it's not complete. So anything I'm going to say to the end of this session when I'm talking about what happens next year, it is all still draft. It is subject to change. So that's me saying, don't hold me to it. There are definitely parts of it which I think won't change, and there's little bits around the edges kind of stuff which may be subject to change. The basic concept is that under this new regime that we will have, only lump sums are going to be tested. There are no tests, no benefit crystallisation events that apply when you take income. So taking drawdown, buying annuity, taking the scheme pension, no age 75 tests, all of that will disappear. You only get tested when you take a lump sum, either in the member's lifetime or if a lump sum is taken on the member's death. That is the only time where we're going to have tests applied. But we are going to have 2 tests, and we have 2 limits instead of 1. So let's have a look at those. So the first limit that we will look at, which is the lump sum allowance. So we're going to have an LSA. So of course, with new regime, we have new jargon for you. Now, the amount of the lump sum allowance looks familiar to you all, I'm sure, 268,275. So it is the same as the PCLS limit currently. There is nothing in the draft legislation to suggest that that's going to rise. It's not linked to inflation, it's no indexation or anything. It's just a fixed figure in the legislation. When an individual takes a lump sum in their lifetime, this will be tested against the lump sum allowance. So PCLS is the most obvious one. PCLS will be tested against this allowance. If somebody takes a UFPLS payment, crystallised funds pension lump sum, then it's just the tax-free element that is tested. It's also the tax-free element of other lump sums, so trivial commutation or winding up, so less common, but you know, it's there in the legislation. That's tested against this. The exception, the only lump sum that you take in your own lifetime that's not tested against this would be a serious ill health lump sum. That's treated differently. But all the other lump sums are tested against this allowance, and it's just the tax rate element that's tested against it. Any excess taken above the lump sum allowance, when you get over the 268,275, you can still take it, but it's going to be subject to income tax on that. The second allowance that we have, and the next bit of jargon, is the lump sum and death benefit allowance. So we have an LSDBA, LSA, LSDBA. The LSDBA, again, is probably a figure that's quite familiar to you, is 1,073,100. So when somebody dies and a lump sum payment is made, then we test against this, but we have to also, any tax-free lump sums taken in their lifetime, which have already been tested against the lump sum allowance, are tested again against the lump sum death benefit allowance. Which I've got an example which explains it more clearly. Serious ill health lump sums are tested against this. So that's the only one in the lifetime, and then it's any lump sums paid on death. And anything over the limit, once you've used up your LSDBA, any payments above that limit, lump sum payments above that limit, are going to be taxed as income on that. So I'll show you a little case study which explains it a bit better, I think. So here we have John, who's 65-year-old. He's got a bit of DB and DC pension benefits build up. He wants to start taking his scheme pension at 65, so he decides to do that, £12,500 a year, and he takes 37,500 PCLS. So we have to do a test now because he's taking a lump sum. So we have these two allowances, the lump sum allowance and the lump sum death benefit allowance. So the 268,275 and the 1,073,100. When he takes his lump sum, it is tested against both of these. Now, that's what it says in the legislation, that you know, you definitely test against both of them. In most circumstances, you're never going to use your LSDBA up if you know, you're going to use your lump sum allowance up first before you use up your lump sum death benefit allowance. So it kind of seems a little pointless in most circumstances why we're testing against the LSDBA in the lifetime. So the only exception is for serious ill health lump sums where you use it up. But apart from that, you know, it's really going to be the lump sum allowance that you're concerned with at this point. So he takes 37,500, so that's used up his lump sum allowance. Some of his lump sum allowance, he's now got £230,775 left for taking future benefits, future lump sums. And, you know, when he dies, he'll have £1,035,600 left for any lump sum death benefits to be paid out. Important point to note here, the fact he's taking scheme pension, that does not get tested at all. A couple of years later, John now starts looking at SIP, decides to take his PCLS from his SIP and to designate the rest to draw down. So again, we'll look at his lump sum allowance. So we had 268,275 is the standard lump sum allowance to start with. He's used up at his age 65, is 37,500. He now uses up another 150,000. So he's got a balance of £80,775 left. We also, if we look at his LSDBA, it means when he dies, his LSDBA available is 885,600. And again, the important point here is you notice there is no test for drawdown. The point he designates it, there's no test. The point he starts taking the income from it, there is no test on that. He dies a few years later, age 73. He's got a drawdown fund value of £560,000. When we look at paying out lump sum death benefits, we don't have to worry about the LSA anymore. LSA is only in the lifetime. So now we are just looking at the LSDBA. So it starts off at 1,073,100. He's used up some of it at age 65, taking his first lump sum, a bit more at age 67, taking his second lump sum. He's now got death benefits. If this is being paid out as a lump sum, that's 560,000. That's still within his available LSDBA. So there's a bit left over. So his lump sum death benefits can be paid out tax-free. He's died under 75, he's within his LSDBA, that can be paid out tax-free to his beneficiaries. Right, I will come on to talking a bit about taking benefits as drawdown in a minute, a bit later on. We're just doing with lump sums at the moment. PCLS, so we've got this limit overall that you can have within your lifetime, your lump sum allowance for your lifetime. But when it comes to the actual rules of how you take a PCLS, so in the moment, we have this idea of, you know, you're taking 25% of the amount crystallized, and we always think of it as 25% tax-free cash. This is all kind of reworded a bit in the new legislation. In practical terms, in most circumstances, it won't make a difference. But I'll come on to a few bits where it might. So the basic idea is no liability to income tax on a PCLS up to what's called the permitted maximum. And then the legislation states the permitted maximum is the lowest of the applicable amount, the available LSA, the available LSDBA. And the applicable amount is a third of the amount you use to provide the income. So in SIP world, it's a third of the amount you put into drawdown. So instead of being 25% of the amount crystallized, the new wording is a third of whatever you put into drawdown, the third of that is your applicable amount. So if you put £75,000 into drawdown, you can have £25,000 is your applicable amount for PCLS. And then because the permitted maximum is the lowest of the applicable amount, your available LSA, available LSDBA, as long as you've got £25,000 of LSA left, then you can have that as your PCLS. So in practical terms, that works the same as it is now. It's just it's kind of phrased differently. Same if you're doing an annuity purchase. There's an equation in the legislation for scheme pension, but it's broadly the same concept on that. So effectively, it's still 25%, but it's a third of what you use to provide a pension up to your LSA. And then say the LSDBA won't be applicable in most times. That won't be the bit that you're limited by. But what's interesting on this is that anything above this permitted maximum is allowed, but it's subject to income tax. And that's quite a change from the current rules. Basically, if you overpaid PCLS previously, it would normally be, to be honest, it would normally be an error. And, if it's a genuine error, there are ways, you can put it back without having any horrible tax penalties. But if you didn't, and a scheme administrator just overpaid PCLS to somebody, anything that's over the allowed amount, the permitted amount, would be an unauthorised payment. And so you'd be looking at an unauthorised payment tax charges, obviously, which would be quite penal. Whereas in the new regime, it's just subject to income tax. So that's not really a big penalty. And if you're looking in DC world, it probably doesn't make that much difference, because you could obviously, under flexi access drawdown, you can take as much as income as you want. So whether you took it as, a taxable, because you've had a bit more PCLS taxable as income, or you just took it as drawdown as income, it's subject to income tax, anything that's above this permitted maximum. So it doesn't really have a massive impact. When you start looking at DB, this is quite a big change, because all of a sudden, DB schemes can now pay potentially unlimited PCLS. Just if it's above the permitted maximum, it's subject to income tax. Now, obviously, a DB scheme previously didn't have that ability. It was either PCLS, which was tax-free, or you're using it to provide a scheme pension. You couldn't take other kinds of lump sums from your DB scheme. So this is one of the things which potentially I think could change when they have the feedback from the draft consultation, from the consultation on the draft legislation, but we'll see. So let's have an example where somebody had a DB scheme, a relatively small DB scheme of say £80,000, but they had a reasonable size, a decent SIP or the DC pension of 1.2 million. Now, under current rules, they couldn't move their DB scheme without taking advice on that, if that was the right thing to do or not. They would only have the option of having a scheme pension from that. They could have a bit of PCLS from it if they took that first before the DC, but they could, so they'd have they couldn't take it as a lump sum, basically. They had to use it as a scheme pension. So whether or not they took any PCLS from it, it's going to be quite a small scheme pension they're going to get out of that, year on year. But they've obviously got other pension savings, they've got a decent sized DC pot. But as the draft legislation stands, it looks as though they could actually, if the scheme allowed it, they could commute all of their DB pension for a PCLS payment. Now, the permitted maximum was the lower of a third of the amount that you use to provide a pension, and your available LSA and your available LSDBA. So if you don't use any of it to provide a pension, to provide a scheme pension, then your permitted maximum effectively is going to be zero, because you can have a third of nothing used to provide a pension is nothing. So the lower of nothing, your LSA, your LSDBA is nothing. So basically you couldn't have any of it as tax-free cash, but you can still have it under the new rules as a PCLS payment. It would just be subject to income tax. But when we do these tests about people taking lump sums and using up the lump sum allowance, it's only the bit that's not subject to tax that uses up your lump sum allowance. So doing that, taking the PCLS but was subject to income tax, wouldn't use up your LSA. So you could still, because you've got a big enough DC pot, you can still get your full 268,275 PCLS out of your DC pot. So you haven't actually lost anything. You're not lost in that scenario any PCLS, because you can just take it from your other scheme. So actually might not be a daft idea to do, rather than taking a very small DB scheme, scheme pension. I'm not sure that's the intention of the rules, but it could be a consequence of them. And obviously that negates the need for getting advice to access your DB scheme. If above £30,000 you need advice, and all the safeguarding things that they've put in place around DB pensions, that kind of circumvents it. So that's why I think it might change, because it just seems a little bit odd. I mean, the other scenario is actually that first one, somebody's quite comfortably off, they've got a decent sized pension fund, is actually somebody who's just got a very small DB scheme, but it's over the limit, so they can't transfer it without taking advice. That actually they may just decide, rather than having a very small scheme pension paid for years, I'd rather have it now, even if I take the income tax hit and I use the bit I lose the PCLS on it, but actually I can get it now and I don't need to take any advice on it, because I can just tell the scheme to give it to me all as a PCLS. So yeah, it's a bit of an interesting one. And the other point on this is a bit of an anomaly as well, because you take PCLS, it doesn't trigger the money purchase annual allowance, so it doesn't restrict obviously paying in the future. Whereas if you took it, it's a flexi access drawdown and PCLS, then you would trigger the MPA. So there's a few sort of implications with that one, which kind of makes me think it could change, but it is an interesting one, I thought, anyway. So moving on to a couple of the bits around PCLS. One of the questions we got asked quite a lot when just after the budget, when it all came out to start with, is that if PCLS is a monetary amount, if you don't take it all out, if you've got DB and DC scheme and your DB scheme pays out less than 25%, can you make it up by taking a higher level of PCLS in your DC scheme? Does that work? And the answer is, it depends. There are certain circumstances where we will have more flexibility going forward looking at the rules. So I'll give you a couple of examples on this. Let's say somebody's got DB, DC, both £800,000. Under current rules, your choices are either you take your DB scheme first, take your max PCLS 200,000 on that, then you've got 68,275 PCLS left for your DC, or you can switch it around and do it the other way around. But quite often we find people want to take the PCLS, would rather take the PCLS from the DC scheme because the commutation factors in the DB. So you might find people would have to take the PCLS from the DC even if they didn't really want it, just because they're going to start the scheme pension elsewhere. Might not be actually really the best thing for them to do, but otherwise they'd lose out with the commutation factor. What you will be able to do under the new rules as they stand is commute just enough to get your 68,275, so you don't lose it in your DB scheme, and you'd still have your 200,000 in your DC scheme. And this is because it's only the lump sum that's tested. So the fact you're taking scheme pension doesn't get tested at all. So it does give you a little bit more flexibility. Next one on here, DB 1.2 million, DC 400,000. If you did your DB scheme first, say you would take all of it from that, there'd be nothing left for DC. If you did your DC scheme first, you would take your 100,000 and have 168,275 left for DB. But under the new rules, you could commute just enough to get what you needed from the DB scheme and still have the 100,000 left in the DC. So there is a bit of flexibility with this. So you have to have the right fund sizes or whatever, things for it to work, but there is some flexibility, and it all comes down to the fact because your income, you're taking your scheme pension, isn't tested. So in the past, you'd have used up lifetime allowance, which would impact your PCLS available elsewhere, whereas going forward, it won't. I'm just going to skip in the interest of time. Another example. Okay, so protections then. Protections from April 24. There is a bit on the protections in the new draft legislation, but without going into all the minute detail, the broad concept is they continue as they are now. So in most cases, there are a couple of exceptions which I'll come on to, but basically, if your clients have got protection and so therefore they have a higher entitlement to PCLS, that will translate, their lump sum allowance will be increased to whatever their current protected PCLS is. So that will be enhanced on there. So that will replace it at whatever level it is that they hold. And then the lump sum death benefit allowance will be increased to the amount of their lifetime allowance protection. So, you know, if you've got fixed protection at 1.8 million, that's what your LSDBA will be, or 1.5 or 1.25. That's what that will be. They have now put a closing date on FP16 and IP16. So they're going to close on 5th of April 2025. Now, so you can still apply for them, and that will give your clients a higher level of protected PCLS. However, if you make applications after the 15th of March, as in the date of the budget, really important to remember, these people can't make contributions. So to apply for FP16, you still can't have made contributions since April 2016, and you cannot make them. It's not as good as people who've always had it, who've had it in place already that can now contribute. It is different. So that's quite a key point to consider when it's you're thinking about applying or not. The main exception then on enhanced protection for the protection changes. So people with enhanced protection, their lump sum death benefit allowance is not whatever their fund is, in the way that, obviously enhanced protection protected you completely from the LTA. It will be restricted to the 5th of April 24 fund value. So I think obviously they've done this is because these people can now make contributions, that people don't just like put loads and loads in their pension and then, it's completely unrestricted. So yeah, it is restricted to the 5th of April 24 fund value. There's another little bit of an anomaly in the draft legislation, which says the PCLS for primary protection where you don't have any lump sum is increased by the protection factor, which it isn't currently. So we think that might be a mistake. That might be something that changes, but that's one we'll just keep an eye on and see what happens when it comes back after the consultation period. Finally then, unanswered questions. Yes, we have a few of those. First one we have here is when this is a screenshot of the finance bill publication. The last page of it, of the 41 pages, there's a bit there that says transitional provision TBC, and that TBC is carrying quite a lot of weight. Yeah, we don't have a lot of information. I think the main thing on this one that we don't know exactly is when you have a client that crystallises benefits, takes lump sums after 6th of April 2024, but has previously taken benefits, how they're going to treat those previous benefits. Which is why, obviously we have records of lifetime allowance usage, and that's why I say we still have to send out the statements this year at BCE events. But we don't, in all circumstances, particularly scheme pensions and things, if they tell you what the lifetime allowance is used, doesn't necessarily relate to lump sums that have been taken. So we don't know how that's going to translate into the new world. We also don't know whether it's going to make a difference whether you took your benefits, in 2022, or if you took them in 2002, and how that relates, in the new world to, has that used up, how has it used up your lump sum allowance, your lump sum death benefit allowance in the new world. They have not given any information on that yet, which obviously could be quite a big factor, how these calculations and how things work. So we simply don't know. It is a watch this space. Other big one is taxation of beneficiaries' pensions. So I've talked about death benefits and paying out lump sum death benefits, because that's in the draft legislation we've seen. There is nothing at all in the draft legislation about beneficiaries' pensions. However, when it came out on the 18th of July, we had this policy paper that was published alongside the draft legislation. And it says, it's just this one line, there was no other information relating to this. It just says individuals will still be able to receive the benefits which are currently tested against the LTA at BCE's 5C and 5D, but the values will no longer be excluded from marginal rate income tax under ITIPA with effect from 6th of April 24. So BCEs 5C and 5D are when uncrystallised funds are used to provide beneficiaries drawdown, beneficiaries flexi access drawdown under 5C, and beneficiaries annuity. So currently, yes, these will be tested on death under 75, because these are benefits that haven't been tested under current rules, haven't been tested against the LTA in the member's lifetime. So at the moment, we have these tests against the LTA, whereas that's going to go, because all the tests are going, around income, but it's saying, yeah, they're going to be subject to income tax, whereas currently, if the member died under 75, obviously beneficiaries drawdown, whether it come from crystallised or uncrystallised funds, wouldn't be subject to income tax normally. So that's quite a big change, sort of policy change, which has not been announced anywhere. You might have seen some industry press that some stories covered this a little bit when this policy paper came out. But say there's nothing on it in the legislation, so we don't have any detail, but it is an interesting one. You know, logic would say to us, well, actually, it should only be subject to income tax if it's above the LSDBA, because that would bring it in line with what they're doing with lump sums. But on the other hand, you know, they're wanting this concept of only testing lump sums and not benefits, income payments, not pension income. So I don't know. So it's definitely a watch the space on this. Obviously, from planning, it would, you know, change things a little bit if you can take it out as a lump sum tax free up to the LSDBA, but if you take anything as drawdown, then it would be subject to income tax. So yeah, it's a watch this space, but yeah, could be some planning implications around that one when we find out what exactly is happening. And then summary, just to finish off then. So for this tax year, current tax year, we still have the lifetime allowance. We don't have any lifetime allowance charges. Big point is for people who've got enhanced or fixed protection, provided they had them by in the date of the budget, they can now make contributions. Next year, LTA is going, but it's going to be replaced by the LSA and the LSDBA. Protections will still be important for people, for your clients, because they will still help them have a higher level of PCLS. It's all still draft though, so things can change. And the big unknowns around the tax treatment of beneficiaries' pensions, how they work, and how previous BCEs under existing or old regimes impact the future lump sums that people can take. Right, that is all from me. So thank you very much for your time. I do hope that's been useful. Goodbye.
Really excellent session. Thank you, Lisa. If there's anything at all you'd like to ask Lisa on the session, then please do let us know and we'll come back to you with answers. But look, that concludes us for today. Should you need to contact me or any of the speakers today, please drop the details in the comment section or on the automatic feedback form, and we'll get in touch very, very soon. And also a reminder as well that your CPD certificate and a copy of today's slides will be sent via email over the next few days. But apart from that, that's all from me. I'll say a big thank you for joining us today. We hope you enjoyed it and we hope to see you on the next one. But bye for now.